Rana Gupta joins us now. He's Senior Portfolio Manager of India and Equity Specialist at Manulife Investment Management. Mr. Gupta, great to have you on the show. Very good morning from where we are.
Good morning.
Right now, yeah, and let's just start about the question of caution. And, you know, my primary question is that what is the concern? What is the biggest negative that could come out of this two-day meet, considering that at 25 basis points is pretty much priced in?
Sure, I think just on the rate cut, whether it is 25 and 50, I think that will definitely cause some short-term volatility in the markets, depending on expectations and other things. But the broad takeaway is this: that the U.S. Fed is now embarking on rate cut cycle. They have themselves said that the rate cut, the extent and the pace will be data dependent. So I think it is not so useful for us who are medium to long-term investors to predict meeting by meeting cut. But broadly, we can take a step back and say that if the inflation is stabilizing at around 3%, even at 50 bps real rate, the rates can go down, let's say, 150 to 200 basis points over a period of time, not immediately. The fact that the Fed is there and they are willing to do whatever, the rate cuts when the data, as and when the data comes in, gives a sense of comfort to us. Having said that, there are risks that you asked. There are risks. Short-term risks are what market prices in vis-a-vis what Fed delivers. That's a short-term risk. In the medium-term risk is that Fed is obviously cutting rate because they see some slowdown in the real economy. Now, whether Fed will cut quickly to take care of the slowdown, that remains the risk. Our view is that Fed is definitely watching the economy and they have to do what it takes. But I think the risk could emanate from that Fed not acting soon enough.
Right. Hi, Rana. It's also Samina joining in. The last couple of months to the run-up to the Fed have seen emerging markets see record inflows. A lot of that money is going into debt, from what we understand. Do you feel that the next couple of months or the next 2 to 3 quarters, it could be debt that outshines equity for emerging markets like India?
I think there are 2 or 3 things. I think particularly if you ask an Indian context, Indian macros in terms of fiscal deficit, current account deficit, inflation, foreign reserve, all these if you map over last 10, 15, 20 years, it has never been this good. So the way to play macro improvement is through debt markets. On the top of that, you have this, bond inclusion, so you get naturally some buying through passive funds and so on and so forth. So I think the debt remains in a pretty good.
Lost the audio.
In a real being where it is, you still get a pretty decent real return. So I think debt from that perspective looks good. But I do think that the broader message here is falling cost of capital, and that in turn is good for equities also.
Okay. Remember, the Fed meet, as everybody now knows, begins today, but the market is pricing in a 62% possibility of a 50 basis points rate cut as per the CME Group's Fed Watch tool. Now, this has moved up from a probability of 25% a month back. Rana, if indeed it is not 50, but it's 25, and the Fed trades on the side of caution, is that a spoiler for risk assets?
In the very near term, it could be, but I think more important for, let's say, medium term is going to be what Fed is going to say in terms of their outlook, how prepared they are to cut, what are their views on the labor markets, whether it's going to be completely data dependent or not, what the committee members think in terms of rates, let's say 6-12 months down the line. So I think Fed rate cut itself is an important event, but the guidance, the press conference happens to that. It's basically, it's also equally important if you have a 3 to 6 months view in the market.
Very lastly, Rana, I'm not sure if you track India specifically, and just moving away from the Fed for a minute, Indian equity markets seem to dance to their own tune in that sense. We've held out quite well. Domestic inflows are very stable for our markets.
Yes.
As an outsider, are you attractive to Indian equity markets, or do you feel like the value here is missing and the risk reward remains favorable for developed markets like the US?
No, so we have been watching to the Indian equities. So I think the question on valuation, I think it's a pretty broad topic, but nonetheless, I'll just highlight a few things. First of all, we don't think for the large cap stocks the valuations are way too expensive, right? Probably the market is trading 10-15% premium to the longer term averages, and in our view, that can be justified given the macro improvement has happened in the economy and the corporate earnings that has grown. But there are in certain pockets there are views that the market's overvalued and it could correct. I'll just put forward what we think in addition to what I just said. See, first of all, domestic flows, as you pointed out, have remained strong. Domestic flows are going to get to about $100 billion plus this year, as opposed to the new equity supply being lower than that. So when there is more demand of equities than supply, the prices are going to go up a bit. So that's the first thing. And then delve a little deeper. Why the supply of equities are lower? Because the corporates, they are protecting their balance sheet, their profits are improving, their cash flows are improving, their ROE is improving, which makes which makes the stocks attractive asset to begin with. And then they are adding capacity only at a very moderate pace, which means the profits can go to sustain for for duration for longer period of time. Also, because the supply of the corporate paper for growth capital is limited, at a time when the demand for equities is strong, the valuation is where it is. I think this demand supply equation for equities is also very important to understand to invest in Indian markets.
Okay. All right. Thank you so much, Rana Gupta.